Whether you put a piece of your paycheck into an index fund every month, or you actively pick your own stocks, you should know that Apple can move the entire market. That's because Apple's stock makes up over 6% of the S&P 500 and over 12% of the NASDAQ. So knowing what they're up to can give you a huge advantage as an investor. But if this past year has taught us anything, it's that just because a company is big doesn't mean it's safe.
Warning about the state of the economy. Market doesn't care, but maybe it should.
Apple recently reported their earnings for 2022, and guess what? Revenues were down by over 5%, and profits were down by over 7%. And if you think that's bad, their free cash flow was down by over 30% year over year. Now with a recession on the horizon, there's only one question left to ask. Will Apple stay on top, or is even this tech giant too risky to touch? Your time is valuable, so let's get right into it. Look, I get it. Weighing in at around $2.4 trillion, Apple is the biggest company on the planet. Not only that, but it's Warren Buffett's biggest holding by far, making up over 40% of Berkshire Hathaway's entire portfolio. Berkshire holds almost 900 million shares of Apple stock, which is worth over $120 billion right now. So I'm not here to tell you that Apple is going to collapse. Even I'm not that crazy. But what you may not realize is that Apple really is under enormous pressure to make some pretty big changes to their core business. For example, recent estimates suggest that 95% of all iPhone supplies come from China, with around 80% of them being made in Foxconn's Zhengzhou factory. But thanks to China's strict lockdown policies around the pandemic, conflicts around wages and working conditions, trade tensions between China and the US, and other geopolitical risks, Apple is under a lot of pressure to diversify its supply chain outside of China. But Apple doesn't just have challenges on the supply side. Demand for personal electronics is becoming a major issue too, thanks to high inflation, fears of recession, and disruptions caused by the ongoing war in Ukraine. In fact, global smartphone shipments fell by 17% this past quarter, making it the smartphone market's worst performance in a decade. These are just some of the real risks that Apple is facing right now. So let me break down their major business segments and explain what's really going on here. Apple is primarily a hardware company. Over 80% of their revenues come from hardware sales, which includes Macs, iPads, wearables like the Apple Watch and the AirPods, and of course, the iPhone. In fact, the iPhone alone accounts for about 56% of Apple's total revenue. That's why there's so much pressure to diversify the iPhone supply chain specifically. Apple's services segment represents the software sides of their business, including the App Store, iTunes, iCloud, Apple TV, Apple Pay, and everything else inside the Apple ecosystem. But here's the thing. Every single one of Apple's business segments was massively successful during the pandemic. Lockdowns forced everyone to stay at home, which meant that consumers were piling money into goods and digital services. For Apple, that meant record growth on all fronts and crushing all analyst expectations, especially in China, where their sales doubled year over year. As a result, iPhone revenues grew by 34% from $147 billion in 2020 to $198 billion in 2021. Revenues from Macs went from $30 billion to $37 billion, a year-over-year increase of 24%. iPad revenues increased by 17% from $26 billion to over $30 billion, and Apple's revenue from wearables grew to over $40 billion in 2021, which is just under a 20% increase year over year. And of course, Apple's services climbed by 27% year over year to just over $72 billion. Apple is the biggest company on the planet, so 20 to 30% growth across every single business unit in a single year is actually pretty mind-boggling. Not only that, but they reported double-digit increases in the amount of new users in their ecosystem. In fact, around half of the Mac and iPad purchases during the pandemic came from first-time Apple buyers, myself included. But that's where the good news ends. It turns out that Apple's growth was pulled forward from the future. Basically, everyone who was even on the fence about upgrading or trying Apple's products decided to pull the trigger, making them much less likely to make another purchase anytime soon. As a result, Apple's Q4 revenues dropped by over 5% in 2022. Their gross profits dropped by over 7%, and their free cash flows dropped by over 30%. That huge drop is because revenues from the iPhone and from wearables were down by over 8%, and revenues from Mac sales were down by almost 30%. The quarter was a stunning miss by Apple, and its first earning miss versus consensus expectations in almost 7 years. It also represented a regression from Apple's success over the past 2 years, driven by a need for new computers to work from home and go to school from home. This was Apple's biggest year-over-year revenue drop since September of 2016. We're all aware that the Federal Reserve has been raising interest rates at a breakneck pace to combat record-high inflation here in the US. But what may not be obvious is that China, which is the largest smartphone market in the world, is also in an economic slump, which is causing iPhone 14 sales to be down by roughly 11% versus the iPhone 13 launch from the year before. But global inflation and recessions aren't the only reason for this lack of demand for the iPhone. Another reason is the iPhone 14 itself, which is one of the smallest steps up when compared to the previous generation.
This is the iPhone 14. Wait, this is the iPhone 14. No, that's a 13, I guess. This is the iPhone 14.
The iPhone 14 is powered by the same A15 Bionic chip, but it only has one more core than the iPhone that came before. It has 2 GB more RAM and small refinements in terms of battery life, photography, and videography. Other than those minor changes, the vast majority of the features of the iPhone 14 can already be found in the iPhone 13. So this lack of demand not only caused Apple to cancel an increase in iPhone 14 production, but they also ended up cutting production by around 3 million units at the end of last year. But lack of demand isn't their only problem. Like I mentioned at the start of this video, recent estimates suggest that 95% of total iPhone supplies come from China, with around 80% of them being made in Foxconn's Zhengzhou factory, also known as iPhone City. That number is as high or higher for Apple's AirPods, Macs, and iPads as well, which means that production of Apple's biggest revenue generators is at the mercy of the Chinese government. This is Apple's single biggest vulnerability and investment risk today. But Apple is doing a few things to cater to their investors. First, they're trying to move at least some of their manufacturing out of China and into India. According to a recent announcement by India's Minister of Trade, Apple wants India to account for 25% of their iPhone manufacturing, up from around 6% today. But there's no concrete timeline for when that'll happen, and even still, that would mean that 75% of iPhone production would still happen in China. Second, Apple has the largest share buyback program on the planet. Apple has spent between $60 and $90 billion per year buying back their shares over the last 5 years, which is at least double the size of the next biggest buyback program. Apple has spent over $500 billion on share buybacks over the last 10 years, which is one reason their share price has been so stable compared to the rest of the market. But there's something else that Apple can and should be doing to solve their supply and demand problems. Here's a quick clip from a recent episode of the All In podcast where David Friedberg predicts that Apple could make a massive business deal in 2023.
Apple ends up buying something completely out of the ordinary. And here's why. I think Apple's core business, they're facing significant pressure with respect to their relationship and ties to China. As you guys may have seen last week, Foxconn announced that they're actually going further downstream in terms of their production model, and they're trying to diversify away from being kind of the sole service provider to Apple. Apple, as you know, is under such pressure to get out of China politically that they've started to try and invigorate activity in Vietnam and elsewhere. So a lot of pressure on their relationship with their low-cost producer and low-cost production partner. They're also under a lot of political pressure because of the App Store revenues. You guys know this 30% App Store vig that they take. A lot of people are calling it monopolistic, and antitrust is getting involved, so they're feeling that pressure. There's also the pressure with respect to the waning consumer demand for high-end electronics. Samsung last week, I think, announced significant declines in consumer demand for electronics, or their forecast as such. That has to impact Apple as well. So when you put all of this together, right, they're being pressured to get out of their low-cost manufacturing center. They're being pressured to stop making money on the App Store. They're being pressured because the demand may be waning. They have to do something big to kind of diversify the business. So I think they might end up doing something like buying a real content company. Maybe they do something like buy a Disney. Maybe they do something like buy an automotive company like Fiat Chrysler. I think there are a number of these kind of like what may seem today outrageous deals that Apple might end up kind of being pressured into doing so that they can get ahead of their forecast of the impact that all these pressures are going to have on their core business.
All right, so here's the big idea. I spent a few days really digging into this, and it turns out that Apple's products are all category killers in every market that they compete in. For example, iOS has a 27% global market share despite only being on iPhones, while Android is on phones from many different manufacturers. Even crazier, Apple owns 56% of the smartphone market in the US, which is almost twice as much as Samsung. Likewise, the Apple Watch is the #1 smartwatch in the US, with around a 45% market share. Almost 1 in 5 Americans owns an Apple Watch. The iPad controls around 50% of the global tablet market, even though Amazon, Microsoft, and Samsung all compete in that space. Likewise, if you combine the AirPods and Beats by Dr. Dre, Apple has about a 31% global market share of wireless headphones. And of course, Apple's Macs were the only computers to gain ground at the end of Q3 last year. Apple's share of the combined desktop and laptop market rose from 8.2% in 2021 to over 13% in 2022, while major computer manufacturers like Lenovo, HP, Dell, and Asus all lost ground. That makes Apple one of the only safe bets in the shrinking desktop and laptop market right now. Hopefully what these stats are showing you is that there's really no such thing as a moonshot for Apple. Whatever market that they decide to enter, their devices immediately rise to one of the top spots. So here's the ultimate question. What if Apple uses their massive cash pile to build or buy their next category-killing product, like Dave Friedberg suggests? And if they did, what would it be? Let's start with smart home devices, since Apple already has products like the HomePod. The smart home market is massive. According to Grand View Research, the global smart home market was worth over $62 billion in 2021 and is expected to grow at just over 27% per year through 2030, at which point it could be worth well over $500 billion. Apple just announced a new line of smart home products, including a new HomePod speaker and an upgraded version of their physical Apple TV. And they'll be introducing a new tablet that's designed specifically to be a smart hub control panel. If Apple can take just 20% of that market from companies like Google and Amazon, they can make upwards of $100 billion in annual revenue, which is about half of what the iPhone makes for them today. Or what about the health and fitness market? Apple already has some pretty unique data thanks to their watches, which lets them record and analyze health data and connect to third-party apps and equipment. But what if they took it a step further? For example, Peloton's market cap is down by over 90% from its peak during the pandemic. Apple could buy Peloton for around $5 or $6 billion right now, add Peloton's massive library of fitness content to their own, and come out with Apple-branded workout machines and gear in a matter of months. Or what if we're not thinking big enough? CCS Insight believes that Apple could offer health insurance as early as 2024. Apple already collects data such as blood pressure, blood oxygen levels, ECG readings, and body temperature from the watch, as well as helping people regulate their medication. The watch and iPhone can also be used to monitor conditions such as diabetes. Like I've been saying video after video, there will be a day when every company can build and train large AI models. When that happens, the winners will be the ones that train those models on proprietary data to get better answers than their competitors. Apple's watch could just be the way that they dominate the insurance market in ways that traditional insurers can't. And while health insurance isn't exactly as exciting as Apple's current lineup, it's a $2.2 trillion market in the US alone today. Forget 20 or 30%, if Apple can capture just 2 or 3% of the insurance market, you're still talking over $50 billion in annual revenue. And while Apple isn't technically a bank, it does take on financial responsibilities including credit checks, lending, buy now pay later services, and offering credit cards and high yield savings accounts in partnership with Goldman Sachs. So maybe we'll see a similar model with insurance, where Apple provides some services themselves like telemedicine and partners with a certified insurer for the rest.
If you zoom out into the future and you look back and you ask the question, what was Apple's greatest contribution to mankind? It will be about health.
And of course, we can't talk about new Apple products without mentioning their upcoming augmented and virtual reality headset. While Apple hasn't officially announced a product, Samsung just announced that their long-term smartphone partnership with Google and Qualcomm is now extending into mixed reality, which is a clear indicator that the AR and VR space is heating up. Mark Zuckerberg believes that the next evolution of the internet will be augmented and virtual reality, and he wants to position Meta Platforms to be its gatekeeper, just like Google and Apple are today with their mobile operating systems and their app stores. Currently, the Meta Quest 2 is the best headset in terms of price, performance, and portability. As of last summer, Meta's headsets accounted for over 80% of the entire VR market, making them the category-killing brand. But Apple doesn't need to build the entire metaverse to compete in this market. They just need to build the best headset and the best app store that sits on top of it, like the iPhone does with the mobile internet today. The VR industry could be worth around $100 billion by 2030. And if Apple captures around 40% of that market, like they have with their iPhones, tablets, and wearables, that's around $40 billion a year, which is more than the iPad or the Mac bring in today. And now we've come full circle. Apple is the biggest company in the world, and it sits at the top of the stock market, but it does have real risks on the supply side, thanks to their products being primarily made in China, and on the demand side, thanks to tough economic headwinds. But because every product they make ends up dominating its category, it's only a matter of time before they make a new one. Smart homes, health and insurance, and maybe even virtual and augmented reality goggles. That optionality, combined with their mind-boggling share buyback program and their willingness to diversify their supply chain, should make them a safe bet for years to come. But before you go investing your hard-earned money into Apple, there's another big risk you need to consider. And if you want to know what it is, just check out this episode next. And if you feel I've earned it, consider hitting the like button and subscribing to the channel. That lets me know to put out more research like this. Either way, thanks for watching, and until next time, this is Ticker Symbol U. My name is Alex, reminding you that the best investment you can make is in you.